Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
So good day everyone, and welcome to the first edition of our Fund Manager interview series. I'm both happy and honoured to have Wayne Jones of Ganes Capital Management as my first guest. Over the past few months, I've trawled through all his quarterly updates for his fund, and it provides a lot of valuable and timeless lessons, especially for the investing community. So I hope this interview will shed more light on Wayne's investing knowledge, experience. Welcome, Wayne. How are you?
I'm good, thanks, Raymond. Yourself?
Yeah, really good. It's raining in Sydney, but I'm sure it's quite humid over in Queensland.
Raining up here as well, and a hot, sticky day, but that's just normal for Brisbane this time of year. So
yeah. So yeah, the last time we spoke, I think you were busy, going to AGM. So must have been a really busy period. How was that?
Good. There's not been too many AGMs. Well, I've only actually been able to attend one AGM in person this year. It's all been virtual, and the one AGM I could go to was PWR, which actually happens to be my largest holding, so it was good. So the others have been virtual, which there are pluses and minuses to that, and there's a bit of news in the media at the moment about it, where you just don't get the same feel from a virtual meeting. The questions and how the directors respond to those questions aren't the same. But then again, you can be at a meeting at 10 o'clock in Melbourne and a meeting at 11 o'clock in Sydney and not miss anything. So there's pluses and minuses to both of them.
Yeah, definitely pros and cons. I guess personally, I haven't attended an AGM like physically, so I do miss that, physical interaction and the behavioural insights you potentially get from attending.
Even just the body language of when they get asked a question sometimes just is the interesting thing. And then also often there'll be other investors there who I'd like to catch up with. If I'm coming down from Brisbane to Sydney or Melbourne, I'll see some other fund managers there, and I'd like to catch up with them at AGMs as well. So it's not just about the company itself. So
we won't bring up too much of the the stress from the quarterly the AGMs. So I might want to get started in trying to understand your personal and professional background. How did you get started into investing, and what made you so passionate about it, I guess?
Well, I can't say it came from my parents. My father worked in an office, and funnily enough, I've just always wanted to be an accountant from as long as I can remember. It was the only subject I was good at school. I was a fairly average student, to say the least, at school. And but accounting just came very easily to me, and I just loved reading about business stories and things like that. When I went off to uni to study accounting, I used to go up to the library, and there was a newsletter up there called Ridges, and I don't even know. I think that might have got rolled into Huntley's or something like that these days. I'm not too sure, but anyway, it was a stock tipping newsletter, and I used to go up there and read all the copies of that. And I remember the first stock I ever bought was a company called Olympic Tyres, which was a tyre manufacturer in Melbourne. And Ridges sort of said, I think this might be a takeover candidate. And sure enough, I don't know, probably a month or two after I bought the shares, Dunlop bought them. And I made about a week's wages in just by owning these shares. And I thought, how good's this? Away I went. Unfortunately, the success was very short-lived because the next stock tip I got was from a guy who I knew in the gym, some resources stock, where he said, I know the directors, they've found, I can't remember what it was, it was gold or something, and you should get on this. And so I thought, beauty. So I invested in that and lost the whole lot. So, we're talking very small amounts of money, but it was a lesson in, you shouldn't always listen to other people when they're telling you they know things. So that's where it came from. The 80s was a very special time. So that's in the 80s. And you had Christopher Skase and Robert Holmes at Court and Ron Briley and Spalvins and Bondi, of course. Lots of stories, very flamboyant characters. I mean, they even created an index in the one of the ASX indexes became the Entrepreneurs Index. You know, if ever that was a siren that this is the top, you know, that was it. And so I just was fascinated reading about those guys. We had lots of business magazines in those days as well. Yeah, Review Weekly was good, and the Fin Review was 3 times the size of what it is now. You'd get stories where there'd be 3-4 pages on a company where they would do these long piece investigative articles. So it was a different time, and made money, lost money. I remember I had shares in FAI Insurances, which was the old Larry Adler business. And of course, it went broke, and so I lost money there. And so it didn't put me off. But then in the 90s, about 1990, 1991, I accidentally bought a book called The Money Masters by John Train. And Money Masters has about 12 chapters in it. And I still have a copy on the bookcase. And the very first chapter was about Warren Buffett. And that was just a light bulb moment. And so once I read that, Walter Schloss, Tweety Brown, I thought, okay, I'm an accountant. These are businesses, not stock prices on the newspaper. And it all just twigged. So from about the 90s, early 90s, I became much more methodical in how I went about my investing and what I was looking at. And I just love, I often say to people, some guys like looking under the bonnet at how motors run in cars. I like reading annual reports and seeing how companies run. Same thing. So, so from the 90s, I was much more methodical, and I wrote, in those days, you had to write away to Berkshire Hathaway to get their annual reports. And so I did that, and I ploughed through all the old annual reports. There was a company at the time which Warren Buffett and Charlie Munger had invested in called Source Capital. So I wrote away to them. It was like an LIC in America. It was run by a guy called George McCallis, and he unfortunately got killed in a motorbike accident probably 20 years ago. But he was a very good investor, and he was very kind and wrote back to me and used to send me all these annual reports and things like that. So I had about a decade there of just really starting to assimilate into that Buffett, Munger, Fisher. I've got to admit, I just find Ben Graham incredibly dry. I've read The Intelligent Investor, as everyone has, but it really didn't resonate with me, except for probably the Mr. Market thing. I'm much more Phil Fisher kind of a person, where you're just looking for a business that's going to grow and how a business runs. And so that was that. And then about 2002, late 2002, a friend of mine and I decided we were both investing. We were both buying very similar companies, and so we decided to start Ganes. And that's Ganes is nothing to do with capital gains. Ganes is just an abbreviation of our 2 last names. So his name is Gaunt and my name's Jones, and so we just stuck the GA and the NES together, and that's Ganes. And so and away we went. And
very nice. Yeah. I guess at the start of your journey, you had a couple of investing lessons that you kind of learned from, and it's evolved over time. Well,
luckily, they might have been expensive lessons in terms of the percentage of my net worth that I lost, but luckily they were just very small amounts. We're talking in the thousands of dollars sort of thing. So nothing that was irrecoverable from. And I mean, I think everyone's got to have those lessons. I think if you have too much success early in the piece, you probably end up with a bit of hubris and think, how easy is this? And I think we're seeing a little bit of that on Twitter these days, where you've got these FinTwit guys trading things and thinking, how easy is this? And okay.
Did those losses ever deter you from, or affect your appetite for investing, like your passion? Or
no. They were just lessons. You'd sort of say, yeah, of course. I actually remember, back in the 80s, coming up and seeing Chris Skase. He had his head office here in Brisbane, because I could not get my head around the cash flow statement, how this Quintex worked. And, he basically was, I won't say he was rude to me, but, it was just like, well, you just don't understand. And so I never ever bought shares in Quintex, but it was just, I just thought you just got to learn how these things work, and they're really businesses. And that was more how it went.
Yeah, that's a very interesting comment, because just going back to what we were talking about, attending AGMs physically, it seemed like the way he spoke and responded to you was potentially a red flag.
Very much so, yes.
Yeah.
I ever met to... Actually, no, I think I may have gone to one of his AGMs. I can't remember now.
Yeah.
I certainly went to... there's some AGMs back in those days. They were very dismissive of shareholders, and it was only the fund managers like Peter Morgan, calling grumpy, and guys like that who would ask questions and sort of call these guys out. It really relied on people like that, and there were good investigative journalists at the time too. So but no, they never deterred me. It was just all a learning curve.
Yeah.
And once I discovered Buffett and Munger and Phil Fisher, I could sort of see where I was going wrong and what the way to approach things. And honestly, since then, it's just been much. I won't say it's been easier, but I can sort of understand what I'm trying to do. It's not, it feels like I've always progressed since then.
Yeah.
I haven't always made money, but I've always progressed.
It's always good. So I was having a look at your professional, I guess, resume on LinkedIn. You've got an interesting timeline there with you started off, not start off as, but your first direct investment experience was a freelancer analyst role at Intelligent Investor? Or?
So how that came about. So Clive was writing for Money magazine, and he just said to me at the time, he said, you should write for one of these guys. You know how to write about the stock market. You know as much as any of these guys. And so at the time, Intelligent Investor put out an ad and said, anyone who wants to write for us, contact us. So I contacted them and I spoke to Greg Hoffman, and he said, look, just send me a piece of a company that you like, which I did. And at the time it was Reese, and he liked it, and so I started writing for Intelligent Investor. So I was working obviously at the time, and so I would write that on the weekends and night time, and I would mostly write about the small cap area. So there were two of us, as James Greenhouse and myself, who wrote about the small companies, and then Greg and other guys like James Carlisle were writing about the larger businesses. And I still speak to those guys on a regular basis today. Greg and I sort of swap share tips and things like that. So, but that was interesting. And I did that for a while, and then it got to be a conflict with the fund. So I sort of had a situation where I wanted to write about the companies I liked, but if I wrote about the companies I liked, I couldn't trade in those companies after I'd written about them for a period of time. And I thought, well, I'm actually putting my unit holders at a disadvantage by doing that. And so, parted ways with Intelligent Investor, purely on that basis. I had to put the unit holders before my writing sort of thing. So, but no, it was interesting. And then at that time, so just to sort of do a loop on that with the business side of things. So in the mid-90s, I was working for a large public company that was buying private hospitals, and I was a finance manager, and I got involved in doing the acquisitions for some of their hospitals in Queensland. Probably did about 7 or 8 acquisitions in that period. Then no secret that was Meij Nicholas, and then Peter Smedley came along, and he wanted to change everything, and my role was going to get taken to Melbourne. I didn't want to move to Melbourne, and so I left, and I got involved with there was a syndicate that were looking at buying a private hospital up here, and they said, would you be interested? Can you come do some work on the valuation for us, and would you be interested in the role? So, and I ended up being involved in that syndicate that bought a private hospital up here. And it was an inner city private hospital, and we ran that for quite some time, and and we sold that to HealthScope after a few years, and moved on from there. So and these days I have some interest in some home care business as well, and things like that. So I'm a bit like Warren Buffett, where I think being a business owner makes you a better investor. And being an investor makes you a better business owner, because honestly, when you own a hospital, it's a very capital intensive business, and so you might have a P&L that's showing you that you're making money, but you've got your hand in your pocket all the time because the doctors are saying, they've got this new machine that goes bing, we need one, and they say, how much is that? That's $500,000. I think, gosh, so having owned a very capital intensive business, it really makes you appreciate the good businesses that don't require a lot of capital when they come along. The businesses that just throw off cash. So I think that's been very. Warren Buffett's in the same boat. Went and bought Berkshire Hathaway, which was an investing mistake 101, but he probably needed to own Berkshire to realise the other business, to go and buy Seas and those sorts of things, where they were much better businesses to own than an old textile mill, which you were just going to have to keep throwing capital at. So sometimes you need that just to give you a bit of an education.
Yeah, it's a very interesting insight, I think, especially for aspiring analysts or people who want to get into industry. I think it's very important to have that business knowledge, I think, first, rather than going straight into, valuation or all the technical stuff that comes with being an analyst.
Businesses do not run on. You need financial statements to know how the business is going, but there's so much more to a business than spreadsheets. It's customers, it's competitors, it's staff morale. It's a whole bunch of things which business is not just this graph that goes up and to the right all the time. You can sit there in an office and model the future of a business, but that's just not how it works. And I think it should almost be mandatory. You have to go and run a business and probably even go broke if you go and do these things. It's I often say to people, go and get your own business, and if you go broke before you're 30, it's no big deal, because you can start again. It's not going to damage you. It's leave it to go and when they cash in their superannuation fund at 55 and go and buy a business, and they've never run a business in their entire life. They're the ones who are, I would caution against doing that. Yeah. Having a good old red hot crack when you're 22, 25, and if you go broke, so what? Just have another. You learn a lesson and then you move on.
On that point, I think about, potential stress that comes with, working in the funds management industry. Is there anything you do outside of work and investing that helps you, take your mind off?
I've got to say, I don't find funds management stressful, but that's because of the situation I've created around myself. I don't have any other people with me. It's me. I'm not part of a big institution that's trying to gather assets. I don't have to present to an investment committee every month. And, why did you buy that? Why has that gone down? I don't have that sort of hassle in my life, and I've done that deliberately. But in terms of personal interests, I run most mornings of the week with a bunch of guys, and have done for years and years. So every morning we get out and run about 8 or 10K along the river here. And they're good because most of those guys are business people. So one of the guys owns an insurance broking business, so it gives me a bit of insight into how the insurance broking industry is going. So it's no accident that PSC and Ausbrokers or AUB are in the portfolio. Another guy, so they've all got business interests. We sit around, we probably spend more time having coffee talking after the run than we spend running. So I run every day. I read a lot. So I probably read 35, 45 books a year. And then I also, I'm learning Italian at the moment. So I'm reasonable at French, and now I thought I'll have a crack at learning Italian so I can actually understand what they're doing when I go over there. So I've got some other interests outside, and obviously you've got family and things like that, and friends I catch up with. But they're the sort of, I find the running every morning is quite good, clear the head, the languages are a bit of a challenge, and the reading's just a nice little diversion. So, yeah.
Is there any reason why you picked Italian?
Because I loved French, and I love the way French sounds when people speak it. So I've learnt that, and I'm reasonable at French, and then Italian because, well, I like Italy, and I love the Renaissance period and Florence and that sort of thing. But also because Italian and French and Spanish they're all Romance languages, so they're all quite similar. So my ambition is to learn it really. I should be able to learn it fairly quickly because the grammar's almost identical. I don't have to sit there so I'm sitting in an Italian class at the moment. We're going through grammar lessons, and they're all struggling with it, saying, why do these Italians talk like this? And It's exactly the way the French talk as well. So the grammar is coming very, very easily to me. So it's really just an exercise in pronunciation and vocabulary. I'm just sort of getting up to speed with. So so I just like that neck of the world. I like that part of the world. And I just like that Renaissance history. When Italy had their little golden patch for about 100 years.
Very nice. Hopefully you can get a chance to go back there.
Well, that's the plan. Probably about 12 months. I'd say it'd be about 12 months before we get back there. But
Great. I think when I spoke with you, you were very generous with your time and sharing your resources, because I think investing is an occupation where you're constantly learning. Learning never stops. So I think it'd be great for people listening to understand what were the key resources and I guess had the most profound impact on your investment philosophy.
So I'm assuming anyone either reading or listening to this podcast is interested in the stock market. But if you even go back a step before that, books like The Richest Man in Babylon, I think are just required reading. If you can't save money, you've got a problem in your life, whether you're interested in the stock market or not. So, and there's been a book written in the last year or two, The Psychology of Money by Morgan Housel. I just think they're required reading for young people. The first thing you've got to learn is, can you save money? You've got to be able to spend less than you earn. And that will also get you around the psychology of having some rainy day money there. If you move on from that, I found Phil Fisher, Common Stocks and Uncommon Profits was a real game changer for me. Shelby Davis, the Davis Dynasty, that doesn't get too much airplay by many people. But Shelby Davis was a public servant working in the insurance business in the government, looking at insurance companies back in the must have been the 50s. And he just spent a career. He left his public service job, and with $50,000 from borrowed off his wife's family, he just started investing in the stock market. And he turned that $50,000 into $900 million by the time he died. Never controlled a company his entire life. He was just a passive shareholder in all these businesses. I think he sat on the board of Geico at one point. So he and Warren Buffett did cross paths a couple of times. But he just turned his $50,000 into $900 million. It's an extraordinary investment record. And it was purely by just doing this slow, patient investing, doing things that you understand, not chasing things. And the interesting thing I found about Shelby Davis is in 1974, the 74 market crash came along, and he was worth about $50 million at that point in time. And he lost 60% of his net worth in the 74 crash, where Warren Buffett, he'd already wound up his partnership before then because he was worried about the market. Charlie Munger lost about 50% of his unit holders' money. But he was about 60, 65 at the time, and he lost 60% of his net wealth. Now, he's still worth $20 million, but that was a big thing. But he just came back from that. He went from then 20 million up to 900 million by the time he passed away. And his grandson has now just been elected onto the board of Berkshire Hathaway, so Chris Davis. So I thought that book was really a light bulb moment for me. I think anything of Charlie Munger, whether you read Charlie's Almanac or whether you just go onto YouTube and watch any of his speeches, that guy I think he's brilliant. Warren Buffett is a brilliant businessman, but I think Charlie Munger has worked out. I think he's a bit more of a rounded individual in some senses of the word, and he's just worked out the things you need in life to have a successful life. And so any of Charlie Munger's speeches, YouTube has been the greatest invention in the last 20 years, where you can just go on there and see watch these guys delivering speeches. If someone, one of the ones recently that I've quite enjoyed was Chris Mayer's book, 100 Baggers. And I've seen a few fund managers now. Monish Pabrai was talking the other day where he said, I've gone from looking for 50 cent dollars, 50 cent, a stock selling for 50 cents, which might go to $1 and double my money and move on, to well, I'm happy to pay $1 if I think the thing will be worth $10 or $100 down the track. I've probably always sort of thought that way for quite some time, but seeing that articulated in that book was interesting. And the other book I quite liked was Peter Thiel's 0 to 1, which is more about startups, but it makes you think about business models. He had this saying, competition is for losers, which is, it sounds rather arrogant, but what he was saying is all successful businesses don't have competition. It's all the unsuccessful businesses. It's the reason why they're unsuccessful is because they didn't avoid competition. You know, there was competition there that eroded their profit margin. So it makes you really think about how businesses work. What else? Look, if you can get through his reading, Taleb, Skin in the Game's his writing is insufferable, but his message is quite strong and quite good. And another couple that never get airplay is Competition Demystified by Greenwald. Now, he's written a few books around Buffett. Again, that sort of talked about how you should look for businesses in niche markets that can dominate their space, because then they'll get these profit margins you don't have to worry about. And Chancellor wrote a book called Capital Returns. And Ed Chancellor's he wrote a book called Devil Take the Hindmost, which is a history of all these financial speculations, you know, these bubbles and things. But he wrote this book called Capital Returns, which is about looking at how the supply of capital in an industry will affect your return. So there's no point investing in a business. Well, I shouldn't say no point, but it's always going to be harder to make a return. If you take the insurance industry, for example, anytime it looks like that business is going to be attractive, capital just floods into that market, pushes the prices down, and no one makes any money. You know, they haven't got good underwriting practices. And what he was sort of getting at in his book is that it's not just about demand for the product, it's how much supply can come into that market to make, you know, to kill the, you know, or satisfy all that demand and some, and then you're left with, you know, a competition to the bottom sort of thing. So they're the sorts of things. I mean, as I say, I found Ben Graham fairly dry reading. Not mine. I've read the book once, and I probably will never read it again in my life. Other books, I think I've probably read the Davis Dynasty 4 or 5 times now. Charlie Munger, I probably not a day in my life I don't watch a bit of Charlie Munger on YouTube. So sorts of things. You just got to have these mental models, and you know, one of Charlie's things which I really admire about him is you just got to have equanimity when you're on the bad end of something. You just got to have some equanimity about it. You know, it doesn't know you. So, yeah.
Yeah, I feel, because Owen did a podcast interview with Peter Pan of Castlereagh Equity, and he felt that from analysing in Munger and Buffett, he felt, as you said, Munger was a much more well-rounded individual in terms of both investing and outside in terms of his personal life. So yeah, that's a very interesting comment you make, because whilst Buffett has been extremely successful, it seems like he may have maybe put too much weight or time towards investing.
Look, I think, you know, sometimes you just got a personality. You know, he was obsessive about it. It was a competition to him, and that's just how he led his life. And yeah, you can't criticize him for that. But when I look at it, I just look and think, well, I would like something a bit more in my life than that. And even if you look at Ben Graham was not in it for the money. He shared all his stock tips with everyone. Anyone who would listen, he would tell them what he was buying. He could speak 3 or 4 languages. He could have been a mathematics professor at university. He translated Greek. You know, the guy, he wrote a screenplay for a theatre. I mean, you know, but you know, the guy had many, many interests in life, and it wasn't about the money. And funnily enough, if you look at Buffett, you know, he's had more money than he's ever needed in his entire life for probably almost his entire life. Well, he was a millionaire at the age of 30, which in those days would have been well and truly enough in the 60s. So he's led 60 years where he's never going to use the money he's made, but he was just so focused on that. But I just look at Charlie Munger and I think, he's probably got life a little bit more sussed in the sense that you know, Warren Buffett might be better at looking at businesses and predicting them, but I think Charlie Munger's got a better handle on the psychology of, you know, what life's about.
And you also mentioned 0 to 1, and also Competition Demystified as those key books where you talk about potentially centers on the idea of fighting unfair. You want to be fighting unfair fights, which is I guess termed by Yen Liao of Arabat Capital, and I think he's coming up to Australia in the Sun's Hearts and Minds conference. So that strongly resonates with your philosophy.
Yes, actually, he's done a couple of videos. I think he did one microcaps.
Yeah, he did.
Fighting unfair fights. That's what you want, and so when you look at my larger holdings, PWR, ARB, they just dominate their space in what they do, and you can see that in the profit margins. I'm always skeptical when someone says, "Oh, I've got 1% of the market, and I'm going to try and get 10% of the market." Well, a whole bunch of other people, the other 99%, they're trying to do the same thing. So you've got to work out why you're so special that you might get 10%. Whereas with, say, something like Google, the moment you get to 50%, your search algorithm is just going to be better than every other search algorithm on the market. And so it just becomes a self-perpetuating cycle where you will dominate the market. It's just there is no other way for another search engine to be better than you. So,
I liked how you used the insurance industry example to show how important it is to think about that. And reading your December 2020 quarterly letter where you reflected on your process, I think one of the key lessons that I really took out from that was not falling for what's hot in the market. And when it comes to financial services industry, you did fall into, I guess, that hot trap, so to speak.
Look, there is no barriers to entry in financial services, and that's, the banks are a barrier to entry in themselves as a group. But if you get the irrits with Commonwealth Bank, you just walk across the road to the ANZ, and when you got the irrits with them, you walk across the bank to Westpac. I mean, there's just, capital is not a barrier for entry in most industries because people will find capital. You've got to think about, I always think about the supply equation even more than the demand equation.
Yeah, we're already seeing it with a lot of the brokerage platforms that are coming onto the market. So it's
and I combine it. Look, Afterpay has been a brilliant business, and those two guys are to be congratulated. But buy now, pay later as a concept. I've never owned Afterpay, and good luck to the guys who have. But I just sort of say, well, there'll be just so many copycat Me Too type businesses that, well, the next guy just come along, offer a little bit less, and maybe Afterpay are that entrenched. They offer some value to merchants, but to me, that just looks like a competitive space run. You've got the banks wanting to do it now. You've got the Visa card, MasterCard and Visa card talking about doing it. It just appears to me as though that could become another example where someone's made a ton of money on Afterpay, but that doesn't mean you make a ton of money in the other companies in that space.
Very interesting. I might be jumping the gun here, but in terms of finding investment ideas, it seems like, would you start on an industry basis, or does it?
No, it goes back to, so 15, 20 years ago, I used to do a lot of, I'd just run a screen and just say, okay, I want to know every company's got a return on equity more than 15%, and I go, oh, okay, there's a company, I'll look at that. I don't do that sort of thing anymore because a lot of businesses, they just don't, the sort of things I tend to end up buying these days sometimes just don't screen very well. And you can see the potential in the business on a screen. So now it's more a case of, well, I don't even look at it on, I wouldn't go so far as to say I look at it on an industry basis, but by owning certain things, you tend to know something about the industry, and then you'll go and look at the other people in the industry and think, oh, okay, well, that's a good business too. So having owned AUB, that allowed me to go and buy PSC recently. So, I sort of feel comfortable with the industry, how it works, what I'm looking at in the financials, that sort of thing. So I don't look at an industry. I never take a macro down top-down sort of view of the world.
Mm.
Someone says to me, "Oh, lithium's going to be really, really big because we've got to make a ton of car batteries. You should be in the lithium industry." That just doesn't resonate with me. I want to see, well, where's the competitive advantage for that business? Because when I buy a business, my turnover is just so low. I'll own a business. Well, ARB I've owned for 20 years. Reece with almost 20 years. So when I look to buy something, I'm looking to buy it for 5, 10 years plus sort of thing. And so I'm not looking for something where, okay, well, it might be really good for this year and next year, but what happens after that? I've just got no line of sight over what their business might look like in 5 years' time. So I just don't take a macro view of the world. And there are just some industries where you get good operators, and they will find a way to make money. And then in an industry that is tough, Graham Turner in Flight Centre comes to mind. Travel agents never made much money, but he found a way to make money. And so he was a guy that was worth backing. But as an industry, the travel agency industry has just always been littered with guys who went broke. So,
So in terms of once you like, maybe you get an itching about a business and it kind of makes you interested, do you have a checklist or a process that you kind of go through?
Yeah. So I'm obviously reading a lot of ASX announcements and things. I'll just go and quickly look at a lot of businesses, but I'm actually sort of filtering businesses out of. I'm looking to exclude businesses because I'm always fully invested. So I've really got to find something. My opportunity cost is my worst idea in my current portfolio. So I've got to find, if I find something, it's got to be better than that. So I'm just always filtering things out. So I'll just go and look at a P&L. Do they make money? I'll try and work out how they make money. Is it clear? One of the questions I always ask myself is, how could they fudge the profits in this business? So to take an example, and I'm not saying this ever happened, but something like Credit Corp and Pioneer Credit, where you're buying debt ledgers, how you amortize those ledgers is very, very important as to what profit you come up with at the end of the day. If you can be quite aggressive in not writing those debt ledgers off, and your profits will look very good, or you can be very conservative in how you write those ledgers off and your profits will look bad. The business is still the same because you're bringing in the same cash flow in, but the profit and loss statement can look very different under two different management teams. So I always ask myself, how could these guys fudge the profits? And so therefore, what should I be looking for? What are the key things to be looking for in the financial statements? One way of doing that is just go and look at how much tax they paid in the cash flow statement. And if they didn't pay much tax or any tax, the tax office doesn't think they made any money. And if the tax office doesn't think they made any money, then probably chances are they didn't. So I'm looking for those sorts of things just as a first glance. I look at the remuneration report. How do these guys pay themselves? Do they sort of? I tend to go for founders, so founder-owned businesses. But that's not to say just because you're a founder that means you're a great investment. There are some founders who put themselves ahead of the queue, the shareholders, and they're taking money off the table before they want to share it with the rest of the shareholders, sort of thing. So I'll go and look at the remuneration report. If there's some red flags in that, it's just a no-go straight away. I'm not going to go, oh, well, he pays himself a bit too much, but I'll put up with that. I just don't like that sort of thing, because those sorts of guys, if they do it now, they'll just keep doing it, and it'll just irk you for the rest of while you're a shareholder, it will just irk you. I'll even go and look at who's a shareholder, and I'll go and look at the top 20 shareholders at the back of the report, see if there's any smart guys that I sort of think are smart guys who are shareholders on the shareholder list. So I'm just sort of running through those sorts of things. And then I'm trying to get a mental model in my head of, well, what does this business look like in an industry? Is this a really competitive industry, or have they got some sort of lock? Or is there some sort of niche here that they've got that the market hasn't woken up to? So there are sorts of things. I'm just, as I say, I'm reading these things. I can go through a thing quite quickly, and probably in 20 minutes, half an hour, go, oh yeah, this looks like I should put this on my watch list and go and do a bit more of a deeper dive, or no, that's rubbish. And just move on. I don't need to spend a lot of time just going through those checklists and working out what I'm interested in. And I've got to sort of understand it as well. I mean, you could come to me with the best business idea and say, Wayne, this is a 10-bagger, lay down misère. I go, yeah, but I don't understand how they make money. Like, I just don't know what it look like in 10 years' time. If you're going to make 10 times your money, good luck to you. And I'm quite happy with that. But, it's just not my go. I want to be able to explain to people, yeah, I understand this is how they make money and what they do.
Is your ability to quickly work out whether or not a business is a good investment, do you think that has been developed through expanding your circle of competence and also, I guess, applying Yen Liao's knowledge or approach to investing, doing a lot of case studies potentially, and having invested in a lot of businesses, you've built that mental model?
Life, as humans, we recognize patterns. Even language is patterns. You say the same things every time. You don't try and think, how will I say that? So when you're looking at financial statements as an accountant, you're just looking for patterns all the time. And so, and if something doesn't feel right to me, I don't need to go and look too far. A lot of people only concentrate on the P&L, and the P&L is one of the easiest things to fudge in accounting. There's the old joke where Alan Bond his accountant used to come into him at the end of the year, and the accountant would say, how much? He'd sort of say, how much are we going to make this year? And the accountant would say, how much do you want to make this year? Because you could just fudge the P&L so easy. But it's holistic. What you put in the P&L has to go into the balance sheet somewhere, and also should also be reflected in the cash flow statement. So you can look at the P&L, but then I'll go and look at the balance sheet as well. Not because I'm looking for assets or anything like that, but what doesn't look right if I don't think there's something right about the P&L. And then I go and look at the cash flow statement, which is, will also tell you as simple things like, did they pay any tax last year? Or is the tax in the P&L something that resembles the tax in the cash flow statement? And if not, why not? They have big, and then you go and look in the balance sheet, they have big deferred tax liabilities. So a deferred tax liability is something where they've told the tax office, no, we didn't make any money this year, but they've told the shareholders, oh, we did make a whole ton of money, but we've deferred that tax and we're going to pay it down the track. So you're just looking for those sorts of little tells in the financial statements. And that's just pattern recognition from years and years of looking at it.
And would you also say that applies to how you evaluate management teams as well? And you pick up, I guess, certain behaviors and personality traits that you've come across in screening previous businesses as well?
Yeah. Well, that's obviously a fairly big tell. If they're very aggressive on the accounting and they're very promotional in their presentations to the ASX, I have this little saying, if you watch a presentation, like an annual results presentation or whatever, that's like an open house display thing. That's the real estate agent giving you the brochure when you walk the door. I actually look at the building inspector's report to see what they found. And so you look at those things, but that gives you, you're not looking at those for information, you're looking at them to get a measure of the management. So, for example, some CEOs, you've got to dial down their ambitions, like you think, okay, well, you've said that, but this is where you've traditionally, you've missed by this much. But other CEOs, you've got to dial up. I mean, Graham Turner at Flight Centre was the most conservative CEO. If he said, oh, we're going to make this amount of money, you just knew it was going to be that plus something. He was just always that conservative. So you're just dialing these personalities of these CEOs, as to what they look like. And then you're just looking for tells in how they behave. So if someone's just being very promotional and, business is so easy, we're just winning so much, new customers and that sort of thing, you think, oh, business doesn't tend to be that easy unless you've got something very, very unique. So just looking for those sorts of things.
Yeah, because I'm actually reading Quality Investing at the moment, which is something that you had recommended on Twitter previously. And it talks about how you can tell a lot by how management speak about their competitors.
Yes.
If they speak about their competitors in a distasteful way, then it's most of the time it's a reflection of their character.
Yes. Yeah. I mean, there's always, most businesses have a decent competitor somewhere lurking around them that they've sort of got their eye on. And yeah.
I also think another big lesson for anyone in general who's interested in investing is, I think people who start investing tend to focus too much. I think personally as well, I focus too much on valuation, getting the price right. And it's hard psychologically to get away from that, because often it's a tangible number that you can attach your mind to. So and you told me that if you get the business right and the management team right, the third aspect of it being the valuation, then that won't be the thing that breaks you over the long term.
Yeah. So Buffett has said that himself. He's looking for three things. He wants a business he understands with a management team he trusts at a price that's reasonably attractive. And he said, and the price is the least important of those three things. So, and I would imagine he's learnt that from Charlie Munger over the years. And so, yeah, because I'm going to own these things for a long time, I can be slightly wrong on the price or my expectations, and that won't matter over the long term. Maybe I might lose a point of percentage here or there, but you've got to be right about the business. And in fact, it's funny that so many analysts and fund managers focus on the valuation, and yet most of them have huge turnover and only hold the stock for months, if luckily if they hold it for a year. And even then, you've got to think, well, what did it matter what the valuation was? You own it, and you basically just rented the stock for 12 months. So valuation is the least important of those criteria. I mean, I'm not going to pay stupid money for a business. It's got to look reasonable. But using a PE ratio as a heuristic, and your biggest, the most important heuristic that you use, is just a huge mistake, because, as I say, your profit and loss statement is the easiest thing to fudge. If you're going to fudge the numbers, you can't fudge what the industry is, how that company's going to perform and what the industry looks like and those sorts of things. That's far more important. And who cares if you might have looked at the business when they've had a bad year. Well, when we first bought Domino's, I went and met Don Meij, and I just walked out of that meeting. I thought he was the best CEO I've ever come across in my entire life, and I still think that 15 years later. But they just had a bad year. They'd gone into Victoria, a marketing campaign had failed. They'd spent some money, looking at Europe, and the profits weren't great. Well, certainly not what the market had expected. But that was the best time to buy it. Not so. Using a PE ratio at that point in time was not the thing to use. It's the same as looking at Berkshire Hathaway after Warren Buffett's taken over, Berkshire Hathaway. Looking at the profit and loss statement for Berkshire Hathaway wasn't the thing. It was, what can this guy do, going forward? And at that time, he only had a textile mill, but if you knew he was going to go into insurance and those sorts of things. So, valuation is just not the most important thing. If you get a company that can compound its capital at really attractive incremental rates, that will fix a multitude of things on valuation.
Yeah, Domino's is a very interesting one, because I only had a brief look at it, and I guess during that time you allude to, when they were trying to open up in Victoria and also Europe, what were the signs that it was a high quality business at that point in time?
Don Meij.
Yeah,
it was a game of inches, and he knew every inch he had to claim to make that business a great business. And you just knew that where he was going. So when he was going off to Europe, he said, Wayne, I'm not taking Domino's Australia to Europe. So I'm taking a 50-year-old American brand that's tried and tested around the world to France. And the French people may not like Americans, but they like American culture. And that's probably representative of a lot of countries around the world. This American culture has really taken over in most, Western culture has really taken over. And so you could just see that France is so much bigger than this market, the Australian market, and how successful he had been. I mean, some of the stories he told me of how he had started. I mean, he started as a pizza delivery driver when he was a training leader. And just one of the things, I'll digress here, but one of the things he did when he started buying his first, he worked up to be a manager. And then when he bought his first store, what he did, he didn't go and look at how many sales they were making. He went and had a look at their phone records to see how many phone calls they missed. And so then what he said is, okay, well, all I need to do is stick more phones in and more staff on the front counter. They'll take more orders and I'll just double my business. And that's what he did. So every franchise, every store he went and bought, he would look at the phone records and then he would just double the number of phones he put into the business. And so he ended up with some of the most successful Domino's franchise stores on the planet. So when you've got someone who's that clever and now taking this business and they run with it, you just think, I just got to back the jockey here. This is going to be a really good business. And I used to get this comment that people used to say to me, but are you eating their pizzas? Like, how can you buy Domino shares, which is a crap? Yeah, but I'm not buying the pizzas. I'm buying the business model. McDonald's, I wouldn't eat McDonald's from one end of the year to the other, but it's the business model. And so you're just thinking about this the wrong way. You're not buying the product, you're buying the business model. And so you could just see that. I mean, where I got Domino's, well, I made two huge mistakes. Well, I made one huge mistake with Domino's. That was selling it. After we tripled our money and thought, oh, it's expensive now. We'll move on. Big mistake. And then when I bought back in, I still thought Europe was the real winner in the group of companies that they had. And Japan's actually turned out to be the best place. So, and they'll get other businesses in Asia. So it's still got a long way to go.
It's a very insightful discussion because it kind of gleans out a lot of the qualitative aspects that you really nailed in terms of determining whether or not Domino's would be a great business. One being Don was, he found a way to achieve high returns on capital for each franchise, and it was super scalable. And it was a matter of him just replicating that. And that comes from him having that background, working as a manager at a franchise store, and then kind of reflects your background as well. Like having been in a business, you know what works and what doesn't.
Yeah, and he was just one of those dynamic personalities. You just knew that it was a game of inches. He knew how long it took to cut a pizza. He said, okay, take 2 seconds off. Like he designed a different knife to cut a pizza, which made the pizza like 2 seconds or 5 seconds quicker or something. He was just so into the minutiae of the inches that he needed to get into. And I didn't know this at the time, but if you look at the Nomad letters, which we've
Nick Sleep,
where he's sort of very renowned for finding Amazon and Costco with this cost saving shared. But he had two other theories he came up with, and one was a dominant scale, which led into dominant marketing, and that's where Domino's. So Don Meij is very clear that Domino's Pizza is a high volume business. It is not he's not competing against the mum and dad making the best Italian pizza in a oven in the suburbs. That's not his competition. He is a high volume business, and so he's translated that into also then being able to just spend money on advertising that those competitors just can't. So when you're thinking pizza, you just become top of mind because you're just spending that on advertising all the time. So you get the scale benefits as well.
I think it's in the name because his name's Don, and it's in the words of Domino's, and it's dominant. So
the Domino has been around for a long, long time. And what I didn't appreciate at the time, but I certainly do now, was the large shareholder Jack Cowan. Having Jack Cowan there, I think Jack Cowan will be one of the most underrated business people in Australia. He had 25% of that business. He bought, paid $400,000 for it. He's never sold a share. It's worth over $1 billion these days. But what he did when he came to Australia with KFC and then Hungry Jack's, I think he's an extraordinary businessman. There's some presentations he's given on YouTube, and there was a podcast recently on the AFR one. He's a very underappreciated, and I didn't appreciate how much he was part of the Domino's picture at the time, but I've come to appreciate that now. Dom was very lucky to have Jack in his corner as he built the business.
I just wanted to touch on the cultural aspect of it. When you said there was a shift of a lot of, I guess, developed countries wanting to embrace the Western culture. And so my parents are from, they lived in Hong Kong. And when I went back to Hong Kong, a lot of the more expensive restaurants like Domino's were like, people were obsessed about it. And you could see it in a lot of countries when you travel around, actually. So it's a very interesting point you make about that. And it's another qualitative, aspect that you can only get from really understanding and observing the environment around you, rather than being in models and spreadsheets.
Well, I'm not the target market for Domino's. I don't buy Domino's pizza, even when they send us our vouchers in the mail, sort of thing. But I know my son, he gets his mates and they've had a few beers. Well, it's just Domino's pizza. And Don said to me once, I said, "What's your best-selling pizza?" And he said, "Oh, 6 meats or something like that." And he said, "And my second best-selling pizza would be, I'd have an even better-selling pizza if I could make it 7 meats." He said, it's young males who just want meat pizzas, and their biggest night of the year is State of Origin. The second biggest night of the year is State of Origin 2. It's just you just got to realise sometimes that you're not the target market, and you can't put your eyes onto what does that product look like. I don't own a 4-wheel drive, but I know people who do, and it's just the go-to product. I just can't sort of think, oh well, I don't own a 4-wheel drive. Why would I pay that much for a fridge or a suspension system? Or I'm just not their target market. I've just got to appreciate how good these businesses are.
In terms of understanding industries, do you spend a lot of time trying to attend conferences or speaking to people in the industry?
It's not structured. If I come across people that are in the industry, I'll talk to them and say, "Hey, how's this work?" I've got a friend who has a 4-wheel drive shop, so I'll catch up with him fairly regularly as to how things are going. ARB last year, as soon as COVID hit, you didn't have to be Einstein to work out that ARB was going to have a good year, because the people going on cruise ships are also the guys who got 4-wheel drives and caravans and the grey nomad. So I rang my friend and I said, he's not a share market person. I said, if there's ever a time to buy ARB, this is it. And he said, yeah, business is going great. I said, well, buy these shares. And that sort of gets back to, I remember you wrote to me, you said, how do I do a discounted cash flow? I haven't done a discounted cash flow spreadsheet for at least 10 years, and I'm probably being generous saying that. And it sort of occurred to me that I've owned ARB for 20 years now, and if I'd stuck in a discounted cash flow statement in 2001 when I bought the first lot of shares, and they'll double their profit in the 20th year from now, I'll sign the biggest deal with the Ford Motor Company, which will probably keep the growth rates going for another decade, if not longer. You couldn't put that in the discounted cash flow model. Everyone would have put their 3%, 4% termination rate in their cash flow statement. And ARB went and doubled their profit in the 20th year I've owned it. So I don't do discounted cash flow statements anymore. It just doesn't tell me what I need to know.
It's interesting you say that, because I think for me, like just starting out and not having that level of experience, I think for me, discount cash flow model has kind of helped me understand the business model. And that's something, I guess, it comes to you quite quickly. It's also very intellectually elegant for academics to teach in business schools as well.
You get your head around, and it sounds very intellectually elegant. I sometimes think that can be a trap that some people fall into.
I think I took a lot away from this discussion, especially about your investing philosophy. And I think the general investing community will learn a lot from this interview. But I think one important thing that I feel a lot of people perhaps not value enough is having good people around you. So to close this interview off, who's had the most influence on your development as a person and investor, and why?
That's a fairly sort of wide question, and I've probably had different people at different times who sort of affected me. So I'd say from if you look at it through a long lens, someone like Charlie Munger and Warren Buffett, as an investor, if you're going to look after people's money, they're the role model of that's how you look after people's money. And probably to an extent, Walter Schloss as well, where they treated it as a profession and they looked after other people's money as if it was more like a doctor-patient sort of relationship, or an advisor sort of relationship. So I think they've taught me how to treat other people's money. I'm not just playing games with it and that sort of thing. I've had some business partners where they've been very wealthy people, and I think they've taught me how you should behave when you have got money. So you don't go throwing weight around and being arrogant. That sort of thing. I've had some fairly good role models there where I thought, okay, even if you are rich, you can still be polite and do that sort of thing. What else? They're sort of the main people. I haven't. Probably just those sorts of people. Where I've had some business partners, and as I said, just looking at how Warren Buffett and Charlie Munger and Walter Schloss and Ben Graham, how they behaved. I just think that's the way to do it. Oh, and look, I probably would give a mention to Greg Hoffman as well, because Greg has taught me how to be a better writer. How to think about what I'm writing about. He's certainly, so when you see that fund update at the end of 3 months, that's just not something I've knocked up in half an hour and just banged up on the website. That's taken quite a bit of thought process, and it's taken some backwards and forwards, with Greg, just sort of, well, what are you trying to say here? What do you want people to take away from this? So I'd add Greg into that, but on a different sort of plane.
It's still a cast to have in the background.
I know that they've been role models, but they have been.
I think writing is an undervalued skill, especially in the investing profession. I think I'm starting to learn or feel the positive impact and benefit from writing out your thesis, and also just journaling as well.
Yes. I'm trying to get to, with the fund updates, I'm not going to write about geopolitical things. Oh, the Federal Reserve said this, interest rates did that, currency did this, this went up, that went down. That's the stuff of daily newspapers, if you want to go and click on that sort of thing. I want the fund updates to be more, well, when I'm writing a fund update, I've got a couple of unit holders in mind, and I'm writing to them how, what would they want to know, how the fund, for some of my unit holders, they just want to see the front page, look at the graph, look at the unit price, and beauty. That's all I need to know. Couldn't care less. So I've got a couple of other unit holders who are interested in what I'm doing, and which businesses I own and why do I own them. And so I'm just writing for them, but I try and really keep the numbers down to a minimum, and I'm just trying to make it a bit more evergreen, that you can go back to these things in a few years' time and read them and just say, oh, okay, now I see why he was buying this, or how he thinks about that business model, and you'll see how they layer. So as I said before, I owned ARB for 15 years, but because I'd owned that for 15 years, I think that allowed me to go and buy PWR, because I could see what ARB had done, and then what PWR had the potential to go and do. And I dare say that there'll be something else. And because I owned AUB, it gave me the knowledge then to go and buy a PSC. And there'll be things I own now where I'm sure that knowledge will layer. I only come up with one good idea every 5 years. And I don't, there's not a good idea out there every week. It's just, I'm fully invested, and I've come up with, as I say, one good idea every 5 years is not burn me, because that's all it needs to be. It'd be nice if there were more. March last year, you just have to be buying. You didn't have to. There were a lot of good ideas out there last year, but not at the moment. So just keep plugging away and just adding layers and layers to that knowledge as it complements.
Yeah, I look forward to seeing and reading your future quarterly updates. I think what you do really well is trying to pass on that knowledge and your point of view, and actually, I guess, teaching people the psychological mindset required in investing. So,
look, I think if people are comparing themselves to some of these guys on Twitter or in the media, social media in general, and thinking, oh, that guy's making a ton of money, I should be able to do that. It's not that easy, but it is easy buying shares. You just click buy or click sell, and it is that easy. But it's not that easy to get those long-term results and not have hit some speed bumps along the way. The potholes is probably more the case along the way.
Yeah, definitely. I think these are really important lessons that I think any investor in the Australian and New Zealand community or across the world should learn from you, and whether it be a novice or a professional investor. So I really appreciate the time that you've provided everyone with, and I'm sure everyone's going to learn a lot from it.
No, appreciate the time as well. You're welcome.